Imagine waking up every day, working hard, paying your bills, and still feeling like you're running on a treadmill that never moves forward. Meanwhile, a small group of people seems to live in a completely different world, one where money works for them, not the other way around. In America today, the top 1% of households control roughly 31.7% of the entire nation's wealth. That's according to the Federal Reserve's latest data from late 2025. To put that in perspective, the top 1% owns about as much wealth as the bottom 90% of Americans combined. This isn't just a statistic, it's a fundamental shift that's reshaping our economy, our politics, and our daily lives. Hi, I'm your channel name, and in this video, we're diving deep into why the top 1% owns so much wealth, how this happened, and most importantly, what it actually means for you, the average American trying to build a better life. We'll look at the real mechanisms, the historical trends, and some practical ways this affects everything from housing prices to your retirement dreams. Stick around, because understanding this is the first step toward navigating it. Let's start with the numbers, because they are staggering. As of the third quarter of 2025, the Federal Reserve reports that the top 1% held about $55 trillion in wealth. That's more than the combined wealth of the bottom 90%. The bottom 50% of Americans, meanwhile, hold only around 2.5% of total wealth. This gap isn't new, but it's widened dramatically since the 1980s. Back in 1989, the top 1% owned about 25% of wealth. Today, it's over 31%. What changed? It's not that the rich stopped working, or that everyone else got lazy. The story is more complex and more interesting than that. One of the biggest drivers is the difference between how the wealthy build wealth versus how most Americans do. For the average person, wealth comes primarily from wages and home equity. You work a job, get a paycheck, maybe buy a house, and hope it appreciates over time. For the top 1%, wealth comes overwhelmingly from capital stocks, investments, business ownership, and assets that grow on their own. Think about it. When the stock market booms, especially with tech and AI stocks in recent years, those who already own large portfolios see their wealth explode. The Federal Reserve's data shows that the top 1% owns over 50% of all corporate stocks and mutual funds in America. The bottom 50% owns almost none. So when the S&P 500 rises 30% in a good year, the benefits flow disproportionately upward. This creates a powerful cycle. Higher wealth leads to more investment income, which leads to even higher wealth. Economists call this capital income inequality. A landmark study by economists Emmanuel Saez and Gabriel Zucman highlights how the surge in top incomes, combined with high savings rates among the wealthy, has snowballed into massive wealth concentration. Another key factor is inheritance and the buy, borrow, die strategy. Many ultra-wealthy individuals buy appreciating assets like stocks or real estate, borrow against them to fund their lifestyle without triggering capital gains, taxes, and then pass those assets to heirs with a stepped-up basis at death. This means decades of gains can escape taxation entirely. Research from the Brookings Institution and others shows that large inheritances play a significant role in maintaining wealth at the top. While inheritances can reduce inequality slightly in the short term because they help some middle-class families, over time, they tend to reinforce existing gaps because wealthy families pass on much larger sums that continue growing. Education and skills have also played a role. The returns to higher education and specialized skills have increased dramatically since the 1980s due to globalization and technology. Those with elite degrees or entrepreneurial opportunities capture outsized rewards. However, this isn't purely merit-based access to top education, often depends on family wealth to begin with. Housing is another massive piece of the puzzle. For most middle-class families, the home is their primary asset. But restrictive zoning laws, NIMBYism in prosperous areas, and limited housing supply have driven prices sky high in the places with the best jobs. This benefits existing homeowners, often wealthier, while making it harder for younger generations to enter the market. Studies from Harvard's Joint Center for Housing Studies show how this dynamic has widened the wealth gap between older and younger Americans, and between regions. Now, let's talk about what this means for you, the average American. First, economic mobility. The idea that anyone can climb the ladder is central to the American dream. But when wealth is highly concentrated, mobility slows. Children born into the bottom 20% have a much harder time reaching the top today than they did decades ago. Research from Raj Chetty's Opportunity Insights project at Harvard shows strong correlations between local inequality and reduced upward mobility. Second, consumer spending and economic growth. The wealthy save and invest a much higher percentage of their income than middle and lower income families, who spend most of what they earn. This can dampen overall demand in the economy over time. Economists at the IMF and others have noted that high inequality can contribute to slower growth if it reduces broad-based consumption. Third, housing and cost of living. When the rich pour money into real estate in major cities, it drives up prices for everyone. Many young Americans are now spending 50% of their income on rent, delaying marriage, kids, and home ownership. This creates a feedback loop where building personal wealth becomes even harder. Fourth, political influence. Wealth often translates into political power through donations, lobbying, and access. This can lead to policies that further entrench advantages such as favorable tax treatments for capital gains or carried interest. A 2011 study found that Americans across the political spectrum underestimate how unequal wealth distribution actually is and prefer a much more even spread. But here's the important part. This isn't a conspiracy. It's the result of market forces, technological change, policy choices, and human incentives playing out over decades. Globalization rewarded companies that could scale globally. Technology created winner-take-most markets in tech and finance. Tax policy shifted emphasis away from taxing capital as heavily as labor. So, what can be done? The goal isn't to punish success. Innovation and entrepreneurship have lifted billions out of poverty worldwide. But smart, balanced approaches can broaden opportunity without killing the golden goose. Ideas backed by evidence include improving access to quality education and vocational training from early childhood through college. Programs that reduce the skills gap have shown strong returns in studies. Reforming housing policy to increase supply in high-opportunity areas. Cities that have eased zoning restrictions have seen more affordable housing and better mobility. Tax reforms that close loopholes like unlimited stepped-up basis or excessive borrowing strategies while keeping incentives for investment. Raising capital gains rates modestly or implementing better estate tax enforcement has been modeled by think tanks across the spectrum. Expanding programs like the Earned Income Tax Credit or Child Tax Credit that reward work and support families without creating massive disincentives. Encouraging broader ownership of capital, things like automatic enrollment in retirement plans, employee stock ownership, or even exploring sovereign wealth funds like Norway's model that distribute returns more widely. The key is focusing on equality of opportunity rather than enforced equality of outcome. When more people can acquire skills, start businesses, and own assets, the pie grows for everyone. Look at history. After World War II, America had high growth with much lower inequality, partly because of broad-based investments in education, GI Bill, infrastructure, and widespread homeownership. We can learn from that without repeating mistakes. For you personally, understanding these dynamics is empowering. Focus on building skills that the market rewards, especially in growing fields like technology, healthcare, and trades. Invest early and consistently, even small amounts. Live below your means. Choose locations and careers strategically. The top 1% didn't get there by accident, but neither are you powerless. Millions of Americans still move up every year through smart choices and persistence. What do you think? Is wealth inequality the biggest challenge facing America, or is it overstated? Drop your thoughts in the comments below. I read them all. If you found this helpful, hit like, subscribe, and turn on notifications, because we're going to keep breaking down these big economic questions in simple, honest ways. Thanks for watching, and I'll see you in the next video.